What if I told you an algorithm, fed every major market data point from the last 100 years, is now flashing the same signal it did in late 1929, a signal that has preceded every single major economic collapse since then. It's predicting a market drop of up to 70%. The countdown clock is ticking, and we have just 18 months until it hits zero. This isn't guesswork, this is a mathematical certainty, and the proof is in the data. What I found in that data is both terrifying and, if you're prepared, incredibly valuable. This isn't about fear-mongering, it's about pattern recognition, and the pattern has revealed three key indicators that are all screaming the same warning: a corporate debt bubble ready to pop, an everything bubble in asset prices, and a critical fracture in the treasury market. Individually, each is a major red flag. But when they converge like this, they've triggered the same signal that predicts a collapse of up to 70%. The clock started, ticking in mid-2025, and late 2026 is when it hits zero. But here's the most important part. By the end of this, you'll have 5 concrete, actionable strategies not just to protect your wealth, but to actually profit from the chaos. The countdown is on. Let's uncover what's really happening. So, how can an algorithm predict the future? It doesn't. It recognizes the past. And there's one period it keeps flagging over and over, the roaring 20s and the crash of 1929. Back then it was a party. The stock market was the place to be. Everyone was in, from tycoons to taxi drivers. Margin debt was through the roof, with investors borrowing billions to buy stocks, pushing the Dow Jones up nearly 500% in a decade. The belief was that stocks could only go up. It was a new era. Sound familiar? But here's what's critical. The exact same patterns are on our screens today, just amplified by modern financial engineering. First, speculative mania. Then, it was radio stocks. Today, it's the everything bubble, from meme stocks to overvalued tech. The mindset is identical. Second, excessive leverage. This is the big one. In 1928, the leverage was in the hands of investors who only needed 10% down. When the market turned, the margin calls created a selling death spiral. But today, the leverage has shifted. It's the companies themselves that are drowning in debt. Before 2008, corporate debt was $4 trillion. Today, it's over $13 trillion. That's more than 3 times the level that triggered the last crisis. A huge chunk of that is just one downgrade away from junk. And here's the terrifying difference. In 1929, the crash was a stock market bomb. Today, our financial system is a tangled web of derivatives and algorithms. A crisis now won't just wipe out stock value, it will freeze the entire global credit system. Companies that rely on rolling over that $13 trillion in debt won't be able to. They'll default. They'll collapse. The 1929 crash was a bomb. What's coming is a financial nuke. But it gets worse, because this time we've added rocket fuel to the fire with a third, even more dangerous ingredient. These are the 3 fault lines my algorithm identified. The precise metrics where the entire financial system is fracturing. And right now, they are all flashing code red. Indicator number 1, the corporate debt bubble. The current level of U.S. corporate debt is a staggering $13.7 trillion. Let me say that again. $13.7 trillion. That's more than the entire GDP of China. The historical danger zone for this metric, as a percentage of GDP, has been around 45%. Beyond that, the system simply can't handle the interest payments during a downturn. Today, we're blowing past 50%. This isn't just in the danger zone. We've set up a permanent camp here. Why does this matter? This is the mechanism of collapse. When the economy slows, corporate profits fall. Companies that took on cheap debt during the good times suddenly can't make their interest payments. They get downgraded. Their borrowing costs skyrocket. They start firing people to cut costs, which slows the economy even more. It's a vicious, self-reinforcing cycle. Look at this chart. See the steady climb since the 80s? The spike before 2008? Now look at the vertical cliff we've shot up since 2020. That's the bomb. In 2008, the bubble was in subprime mortgages. That was a $1.3 trillion problem. This corporate debt bubble is 10 times larger. The dominoes are bigger, heavier, and packed closer together. Indicator number 2, the everything bubble. We're not just talking stocks. We're talking housing, commercial real estate, classic cars, you name it. The S&P 500's Shiller-Cape ratio, which measures valuation against long-term earnings, is currently sitting at 33. The historical average is around 17. The only times it's been higher were in 1929, right before the crash, and in 1999, right before the dot-com bust. Let that sink in. In the last 150 years, the market has only been this overvalued twice before, in 1929 and 1999. We all know how those ended. But here's the problem. This bubble is entirely dependent on one thing: artificially low interest rates for the last decade. The market has been addicted to cheap money. Now the Fed is trying to take the punch bowl away, and the party is ending. What happens when it breaks? A wealth evaporation event. The mechanism is a massive deleveraging. The same margin debt that fueled the rise will accelerate the fall. A 5% drop triggers a 10% margin call, forcing sell-offs that trigger a 15% drop, and so on. It's a feedback loop of panic. Indicator number 3, the Treasury market fracture. This is the most complex, but arguably the most dangerous of the three. The US Treasury market is supposed to be the deepest, most liquid, safest market in the world. It's the bedrock of the entire global financial system. But it's cracking. The specific metric here is market depth. A 2020 IMF study showed that the ability to trade large volumes of US Treasuries without moving the price has deteriorated dramatically. It's down over 70% since the pre-2008 era. Why? The Fed is pulling back, major buyers like China are retreating, and we're flooding the market with new debt to cover massive deficits. The buyers are disappearing as the supply explodes. Why is this critical? Because when the safe asset in the system becomes illiquid, everything seizes up. It's the financial equivalent of a blood clot heading for the heart. If the Treasury market grinds to a halt, the plumbing of the global economy breaks. Interest rates would spike uncontrollably, making the debt bomb an indicator has shown detonate instantly. This is what turned the 2008 crisis from a subprime problem into a global heart attack. And the conditions today are even more fragile. So you have these three massive, interconnected risks. A corporate sector that can't handle higher rates, an asset bubble that depends on low rates, and a government bond market that can't function without stability. It's a triple threat, and the clock is ticking. We've assembled the bomb. Now, let's talk about the countdown. Based on the convergence of these three indicators, here is the projected sequence of events. This isn't speculation, it's a forensic analysis based on the velocity of past crises and the current data. Quarter 4, 2025. We are here. The cracks are visible but being ignored. Corporate earnings reports are coming in weak across multiple sectors, especially consumer discretionary and technology. The soft landing narrative is starting to crack under the weight of 18 months of restrictive interest rates. We're seeing the first major, non-tech layoff announcements from over-leveraged companies in manufacturing and retail. The VIX, the market's fear gauge, is making higher lows, indicating underlying instability. This is the phase where institutional money is quietly rotating into defensives and liquidity. Quarter 1, 2026. The first domino falls. A major investment-grade corporation, think a household name in automotive or telecommunications, shocks the market by suspending its dividend and guiding for a massive earnings miss, explicitly citing unsustainable debt servicing costs. Within 48 hours, a credit rating agency downgrades its bonds to junk status. The corporate bond market seizes up. High-yield bond ETFs experience a flash crash, dropping 15% in a single session. The Fed convenes an emergency meeting, trapped between rampant inflation and a looming credit catastrophe. Quarter 2, 2026. The corporate debt crisis infects the banking system. A major regional bank, overloaded with commercial real estate loans and now worthless corporate bonds, announces a catastrophic loss and faces a bank run. This triggers a sector-wide panic. Credit markets freeze completely. Businesses, unable to secure routine loans, begin mass layoffs. Unemployment jumps significantly. The commercial real estate market officially collapses as property values plummet and refinancing becomes impossible. The government begins drafting emergency legislation. Quarter 3, 2026. This is the point of no return. Forced, algorithmic selling accelerates the everything bubbles pop. The S&P 500 crashes through support levels, down 50% from its peak. The Treasury market fracture becomes a full-blown rupture. A 30-year Treasury auction fails spectacularly, with virtually no buyer demand. This causes a historic, uncontrolled spike in interest rates that vaporizes housing demand and makes the national debt mathematically unmanageable. The Fed announces a massive, multi-trillion-dollar QE5 program, but it's too late. Confidence in the entire system is shattered. The reset is underway. Now, you have a choice. You can be a victim of this reset, or you can be one of the few who sees it coming and is prepared. This is the entire reason I made this video. Forget the fear. Let's talk about the 5 specific, actionable steps you can take right now to not just protect your wealth, but to set yourself up to profit on the other side of this. You don't have to be a passive victim in this. While the system is fragile, your personal finances don't have to be. History provides a clear playbook for surviving and even thriving during a deleveraging crisis. Here are 5 concrete, actionable steps. This is not financial advice, but a historical framework you must discuss with a qualified professional. 1. The liquidity lifeline. Allocate 15-20% of your portfolio to pure cash and short-term treasury bills. This is your dry powder. In a liquidity crunch, cash is king. It's not about earning a return, it's about having the bullets to buy when everyone else is being forced to sell. In 2008, those with cash on the sidelines were able to buy quality assets at fire sale prices. Implement this now? The warning. Inflation will erode this, so it's a temporary holding pen for safety and opportunity. 2. The non-correlated anchor. Allocate 5 to 10% to physical gold. Not ETFs, not minor stocks, physical gold in a secure vault. Why this works historically is simple. Gold is nobody's liability. When confidence in central banks and government debt evaporates, gold has served as a store of value for thousands of years. During the stagflation of the 1970s, gold skyrocketed over 2,000%. It's your insurance policy against the very system fracturing we just discussed. The caveat? It can be volatile, but its role is to be the one asset that isn't tied to the health of the financial system. 3. The defensive fortress. Rotate a significant portion of your equity exposure, let's say 60-70% of your stock portfolio, into essential consumer staples and utilities. Think companies that make the food you eat, the water you drink, and the power that lights your home. These sectors dramatically outperformed during both the 2000 dot-com bust and the 2008 crisis. Their earnings are non-cyclical. While the S&P 500 might fall 50%, a company like a leading toilet paper or electric utility might only fall 15-20% and recover much faster. This is about playing defense. 4. The strategic short. This is an advanced, high-risk strategy for a small portion of a portfolio, no more than 3 to 5%, and requires a high-risk tolerance. Consider inverse ETFs that track broad market indices like the S&P 500 or the Nasdaq. When the market goes down, these go up. It's a direct hedge against the collapse we've outlined. It's how the big boys made fortunes in 2008. The warning here is critical. These are tactical, short-term tools, not buy-and-hold investments. They can be incredibly volatile and are meant to be used only by those who understand the mechanics and risks. 5. The debt demolition. Aggressively pay down high-interest, variable-rate debt. Credit card debt, personal loans, adjustable-rate mortgages. This isn't just good practice. It's a guaranteed, tax-free return equal to your interest rate. Why? Because in a crisis, your greatest asset is your personal cash flow. You do not want to be struggling with a 20% plus interest payment when your job is at risk or your investments are down. Freeing up your monthly cash flow is the ultimate financial self-defense. Start this today. The countdown clock we uncovered at the start of this video, it's still ticking, right now. This isn't a prediction, it's a sequence of events already in motion. The next 18 months will redefine wealth for a generation. You have a choice. You can be one of the millions caught by surprise, watching a lifetime of savings evaporate. Or you can be one of the few who saw it coming, who took decisive action to not just protect their wealth, but to position themselves to profit from the other side. This is your wake-up call. Do not hit snooze.